Many young people ask me the absolute secret to building massive lifelong wealth, and I tell them the truth, but nobody wants to believe it. Everyone loves the comforting lie of a smooth, predictable global economic market, while their actual life energy gets systematically melted away by hidden macroeconomic traps and calculated political theater. We have been conditioned to stare at the minor daily fluctuations of the federal funds rate like brain-dead retail drones, while completely failing to realize that the entire monetary policy machine is being completely dismantled right in front of our eyes. Every single unexamined trust you place in the independence of the central banking system is an open invitation for cognitive paralysis and the absolute destruction of your real purchasing power. I recently found myself looking at some incredibly alarming geopolitical variables and a massive structural regime shift occurring at the absolute peak of the United States financial infrastructure. If you actually look at the raw empirical math of the latest inflation data releases through a completely detached, rational lens, you realize that the standard textbook economic playbook has been completely burned to the ground. The mainstream media platforms love to keep you entirely focused on superficial political arguments, because keeping you emotionally agitated prevents you from seeing the actual mechanics of the elite capital preservation game. We need to sit down and have an incredibly brutal and honest conversation about the massive systemic chess match happening behind the confirmation of the new Federal Reserve chairman. Every single financial commentator who tells you that interest rate cuts are going to magically save the domestic retail consumer is selling you a toxic narrative designed to keep you completely passive. My name is Dean Si, and I analyze the global wealth engine through the lens of pure mathematical probability logic and unshakable behavioral discipline. I watched how retail speculators gamble their life savings away on short-term option chains, while sophisticated institutional insiders quietly position their balance sheets to survive an absolute generational economic shock. Our mission today is to tear down the walls of traditional institutional gaslighting, so you can see exactly how a manufactured economic crisis is being utilized to secure total executive dominance over the money supply. The corporate political complexes will never teach you how to achieve absolute personal financial sovereignty, because they profit directly from your financial confusion and your reliance on their broken tracking systems. Let us journey directly into the absolute raw numbers of the massive data releases that dropped over the past 48 hours so you can witness the real magnitude of the emergency. The United States Senate officially confirmed Kevin Warsh as the next chairman of the Federal Reserve in a highly contentious 54-45 vote, split almost entirely along partisan lines. The mainstream economic commentators are already screaming that this institutional regime change will automatically usher in a massive wave of rapid interest rate cuts to appease the executive branch. But if you possess a single grain of independent critical thinking capability, you realize that the direction the new chairman claims he wants to take interest rates does not match the empirical reality of the ground floor economy. The United States Bureau of Labor Statistics just reported that the producer price index for final demand increased by a staggering 1.6% in the single month of April. This massive wholesale inflation surge represents nearly triple the baseline expectations of every single mainstream Wall Street economist surveyed prior to the data release. You have to look back over 4 years to the historic market dislocations of March 2000 RSR to find a hotter monthly producer price indicator than the number we just received. Even if you entirely strip out the highly volatile categories of food and wholesale energy costs, the core producer price index still advanced by a whopping 1% in a single month. At the exact same time, the consumer price index for the month of April accelerated to a scorching 3.5% year-over-year compared to previous baseline reads of 3.7% and 3%. This is not a temporary statistical anomaly or a minor bump in the road. This is an absolute accelerating upward trend of structural domestic inflation. The absolute most horrifying aspect of these hot data points is that these numbers only capture the absolute initial fraction of the major geopolitical conflict involving Iran. The global energy supply chain is currently absorbing the largest structural disruption in the history of the world oil market because the Strait of Hormuz has been effectively closed since March. Over a third of the entire global strategic oil reserves have already been frantically released into the open market in a desperate attempt to stabilize retail energy costs. Commercial maritime tankers are completely frozen out of the primary shipping channels, meaning that this massive supply chain shock is deepening every single minute of every single hour of every single day. We have officially passed the absolute point of no return in the modern inflation cycle, and the traditional tools of central bank manipulation are completely neutralized. To understand exactly why the traditional monetary playbook is completely broken, you must master a single critical macroeconomic concept known as fiscal dominance. Fiscal dominance manifests when a sovereign nation budget deficit and total outstanding public debt grow so massive that they completely castrate the standard mechanisms of monetary policy. In a normal economic environment, a central bank can easily cool off an overheating system by raising short-term interest rates to make borrowing expensive and encourage retail saving. But under a regime of fiscal dominance, the sheer structural weight of $35 trillion of sovereign debt completely dictates the long end of the yield curve. The global bond market looks at the astronomical trajectory of the United States deficit and naturally charges a massive risk premium to hold long-term government bonds. The international financial community has looked at the raw numbers and collectively determined that the United States, under its current administrative management, is a significant credit risk. Therefore, the entire public narrative that a single individual can waltz into the Federal Reserve building wave a magic wand and instantly bring consumer interest rates down is completely preposterous. The Federal Open Market Committee operates as a 12-member voting bloc, meaning that the new chairman cannot unilaterally shift the trajectory of interest rates without building institutional consensus. Furthermore, everyday consumer loan vehicles like 30-year fixed mortgages and retail auto loans are not tethered to the overnight federal funds rate controlled by the central bank. Those consumer rates are completely anchored to the 10-year United States Treasury yield, which is actively soaring past 4.0% as the bond market prices in structural inflation and geopolitical risk. Mortgage rates have surged right back towards 6.0%, meaning that the absolute affordability of basic shelter for the average working family has completely collapsed. While the Treasury Department desperately attempts to create artificial global demand for the domestic currency by offering desperate swap lines to foreign sovereign wealth funds, the world is taking notice. When the world's most historically reliable borrower starts behaving like an erratic, unreliable actor, international capital automatically seeks alternative safe havens outside the dollar matrix. Let us examine the profound structural difference between the post-pandemic inflation spike and the toxic inflationary wave we are currently experiencing today. During the initial inflation surge of 2000 through 2000 our corporate executives actively exploited real global supply chain snarls to gouge everyday consumers. Extensive empirical research proves that corporate profit margins accounted for nearly 50% of total consumer price increases as companies took advantage of families flushed with stimulus cash. Corporate leaders openly bragged on institutional earnings calls about their ability to take price from a captive consumer base that possessed excess liquidity. But today, the domestic consumer is completely tapped out, credit card balances are at all-time highs, and real household wages just fell by 0.7% year-over-year. Corporations know with absolute certainty that they can no longer gouge the customer directly, because the average household balance sheet is completely empty. So instead of raising prices to fund productive business expansion or increase worker compensation, corporations are utilizing their massive liquidity to execute defensive stock buybacks. Buyback authorizations across the major domestic stock indices have surged by 36%, putting corporate entities on track to repurchase close to $1 trillion of their own shares this year. This massive wave of capital allocation moves wealth directly into the pockets of senior shareholders, while everyday workers are forced to absorb the full impact of rising energy costs. The wholesale price increases trapped in the current producer price index pipeline will automatically pass through directly into retail grocery bills and utility statements within the next 60 days. With wholesale gasoline prices surging over 15% in a single month, the working class is facing an absolute mathematical emergency, while the wealthy class completely insulates itself. The sophisticated investor class is already aggressively hedging to the downside by pulling massive blocks of capital entirely out of active circulation and parking it in liquid cash equivalents. This mass migration to cash is highly contractionary for the broader real economy, because that wealth is no longer funding business creation capital expenditures or long-term employment growth. It creates the absolute worst of all financial worlds for everyday citizens, a system where productive investment completely dries up, while the cost of basic physical goods continues to skyrocket. Now, I need you to focus your absolute cognitive attention on the massive structural trap being set for the central banking institution itself, because this is where the real game is being played. Senior economic advisors aligned with the current administration recently co-authored a highly strategic white paper that serves as an absolute operational blueprint to overhaul the Federal Reserve Act. These official proposals include giving the executive branch the explicit power to fire regional bank presidents and central bank board members at pure political willpower. The blueprint strips the central bank of its financial autonomy by placing its entire operating budget under the direct control of congressional appropriations processes. It systematically shortens the traditional 14-year terms of governors, which were originally engineered by economic architects to completely insulate monetary policy from short-term political election cycles. As major global banking institutions have privately warned, these structural changes would materially hand total control over domestic monetary and regulatory policy directly to the president. You might be tempted to dismiss these radical proposals as fringe academic theories that could never clear the traditional legislative hurdles or survive a senatorial filibuster. But if you analyze the history of autocratic capital shifts, you realize that these elite policy documents are written specifically in search of a massive crisis to make them actionable. We are sitting right in the center of that exact manufactured crisis today, with inflation ripping, energy costs exploding, and global bond markets under severe structural stress. The executive branch can now stand directly in front of the media cameras and claim that the entire economic system is falling apart because a broken independent Federal Reserve is acting against the people. The new insider chairman can intentionally cultivate what corporate media outlets call a regime change agenda, publicly welcoming a hostile fight with the very institution he leads. He does not need to win the internal committee votes to lower interest rates. He simply needs to be publicly seen losing those votes to create a perpetual narrative of institutional obstruction. This entire macroeconomic crisis is a highly sophisticated pretext designed to put the absolute interest rate decision, and more importantly, the ultimate financial bailout decision, under the sole purview of the executive branch forever. They write these systemic plays down like classic Bond villains waiting patiently for the absolute perfect moment of public panic to execute their strategy and dismantle institutional checks and balances. If you are still sitting at home treating this current economic landscape as a standard cyclical market correction, you are completely failing to see the broader chessboard. When the structural rules of the wealth game are being radically rewritten by elite players, you must completely abandon all speculative behavior and retreat to a position of absolute mathematical invincibility. You cannot successfully time a market correction that is driven by unpredictable geopolitical warfare and highly coordinated administrative policy distortions. The absolute only path to personal economic sovereignty is to completely starve the financial matrix of transaction fees and refuse to participate in their high-speed speculative casino. When you systematically route your savings away from individual stock picking and place it directly into diversified low-cost total market index funds, you are automatically insulating your wealth from corporate and political corruption. You do not need to possess non-public data regarding which specific defense stock or energy conglomerate will receive the next corrupt government subsidy, because your index portfolio already owns a piece of the entire productive economy. You are effectively leveraging the aggregate survival instinct of human ingenuity to compound your capital, while completely bypassing the emotional noise manufactured by the media to keep you trading every single time you panic. Execute a short-term trade or pay a massive management fee to an institutional advisor, you are actively firing a financial soldier from your wealth machine. True long-term wealth accumulation through the rational framework of Charlie Munger is an incredibly slow, boring, and deeply unglamorous process of quiet, persistent capital accumulation. It requires you to cultivate a radical internal behavioral discipline that completely tunes out the terrifying headlines and focuses entirely on the long-term exponential mathematics of passive compounding. Stop wasting your precious limited cognitive bandwidth crying about a rigged macroeconomic system that you lack the structural power to reform through raw emotional outrage. Instead, redirect that identical energy toward maximizing your personal savings rate, automating your recurring investments, and aggressively expanding the gap between your production and your private consumption. Treat every single unit of currency you successfully preserve as a permanent employee designed to work 24 hours a day to buy back your irreplaceable time and your ultimate freedom. True freedom is not found in chasing hyper-speculative asset bubbles or participating in the frantic lifestyle inflation promoted by a broken debt-based social order. True freedom is the absolute capability to look at the entire institutional matrix, wake up every single morning, and control your own schedule with absolute, unshakable confidence. Let the political establishment engage in their high-stakes short-term structural games while you quietly construct a massive, invincible fortress of generational wealth in the background. Do not let their manufactured crises or out-of-touch public narratives distort your rational view of long-term asset allocation or compromise your adherence to the basic laws of mathematics. Stay incredibly boring with your low-cost index funds. Stay completely patient with your automated compounding timeline piece.